The house always wins, unless it owes $18 billion. 8 Las Vegas casinos, from forgotten off-strip gambles to billion-dollar empires, all went broke. We are counting them down by the scale of their financial destruction. Misread locations, toxic debt, leveraged buyouts that poisoned entire brands. Some collapsed in months. One may be collapsing right now. Starting at number 8, a casino that died faster than any in modern Vegas history. 8th place, Lucky Dragon. Built to lure Asian high rollers, Lucky Dragon opened on West Sahara in December 2016, just half a mile off the strip, but a world away from steady foot traffic. The casino floor went dark in January 2018, barely 13 months after opening. By February, the owners filed for Chapter 11, listing $143 million in secured debt and burning through $200,000 a month in losses. The property, once billed as a luxury oasis, was auctioned off for $36 million, less than a quarter of its debt. Geography, not glamour, sealed its fate, proof that the house doesn't always win. Number 7, the Aladdin stands as a warning about timing and ambition colliding on the strip. After a lavish $1.2 billion overhaul, the property reopened in 1997, just as Las Vegas was heading into a market downturn. By September 2001, the Aladdin filed for Chapter 11 bankruptcy, burdened by debt it could never hope to service. More than $1 billion on the books as creditors circled. The casino limped through court protection until 2003, when it was sold off and rebranded as Planet Hollywood for just $150 million. The strip does not forget, it just reruns the tape with a new name. Number 6, SLS Las Vegas tried to outpace its own history. After a $138 million purchase in 2014, the old Sahara was gutted and rebranded as SLS, promising a new era of boutique luxury. But the numbers never worked. Every year brought fresh losses, with 2017 financials showing red ink that no amount of nightclub marketing could erase. By 2019, the brand reversal to Sahara was less a comeback than a retreat. It was an admission that surface-level reinvention cannot fix a property that does not fit its market or its debt. The strip will always punish arrogance dressed up as vision. Number 5, Station Casino stood as the backbone of the Vegas locals market until the math caught up. In 2009, the company filed for Chapter 11 protection, buried under nearly $6 billion in leveraged buyout debt. The timing could not have been worse. The financial crisis had gutted gaming revenue, leaving Station with interest payments it could not meet. The bankruptcy docket lists $4.9 billion in secured debt and another $1.1 billion owed to unsecured creditors. Asset sales followed, including the Aliante Casino, as Station scrambled to meet creditor demands. Thousands of jobs hung in the balance, and the company's future depended on liquidating properties just to stay afloat. Leverage, once a tool for expansion, became a trapdoor. If you have made it this far, you already know number 1 is going to hurt. Subscribe so you do not miss what comes next. Number 4, the Riviera casts a long shadow over the strip's history, and its erasure is a lesson in the economics of land. Opened in 1955, the Riviera survived 6 decades of boom and bust before the numbers finally caught up. By 2010, the property was buried under $560 million in secured debt, with creditors circling and operations bleeding cash. Court filings set the stage for liquidation. The resort was auctioned off for just $90 million, a fraction of its peak value. In 2015, the doors closed for good. Demolition permits were issued the following year, and the legendary neon facade came down in clouds of dust. Not a rebrand, not a restructuring, just a clean sweep for future convention space. The Riviera's implosion didn't just wipe out a casino, it erased a piece of Vegas mythology, proving that even icons can be reduced to a line item on a developer's balance sheet. Coming to the top 3, Fontainebleau, Las Vegas stands as a monument to ambition, frozen by financial panic. Construction began in October 2007 with a $2.9 billion budget, promising a new era of strip luxury. But by mid-2009, just as the tower reached 60 stories, the credit markets collapsed. Lenders pulled support, leaving the project stranded, 60% complete, but entirely lifeless. Chapter 11 was filed that June, and what followed was 14 years of dormancy. The unfinished blue glass monolith became a ghostly fixture on the skyline, a daily reminder of the risks that come with billion-dollar bets. In 2010, Carl Icahn acquired the shell for $156.5 million, then sold it in 2017 for $600 million, a fraction of the original cost. Ownership changed hands again before a fresh round of financing finally brought the doors open in December 2023. For over a decade, Fontainebleau was less a casino than a warning. In Las Vegas, even the biggest dreams can be left to gather dust when the money runs out. Number 2, Caesars Entertainment in 2015 stands as a warning about what happens when private equity turns a casino empire into a collateral pool. In 2008, Apollo Global Management and TPG orchestrated a leveraged buyout that loaded the company with nearly $18 billion in new debt, all justified by the promise of endless growth. For a while, the illusion held. More than 50 properties from Caesar's Palace to Harrah's were propped up by borrowed money and optimistic projections. But as the financial crisis deepened and casino revenues flattened, the numbers became impossible to mask. By January 2015, Caesars filed for Chapter 11 bankruptcy, listing $18 billion in liabilities, one of the largest corporate defaults in American history. The bankruptcy docket reads like a corporate autopsy. Interest payments were swallowing cash flow, creditors were fighting over the scraps, and there was a $7 billion haircut before the company could emerge in 2017. The same company, the same playbook, only the names on the debt changed. Caesar survived, but the scars remain. The entire network of properties, jobs, and brands was nearly erased by the slow poison of leveraged buyout debt. And as the capital structure was rebuilt, the seeds of future risk were quietly sown. In a city built on the illusion of permanence, Caesars proves that even giants can be brought to the brink, not by a single bad bet, but by a system designed to gamble with everything. And finally, in first place, Caesars Entertainment stands on the edge of another financial reckoning. The numbers from 2025 read like a warning flare, a 52% collapse in share price from $68 to $33 per share, erasing billions in market value. Annual interest expense now consumes $2.3 billion, a figure that outpaces operating profits and leaves the company with an EBITDA to interest coverage ratio of just 0.63, far below the 1.5 times covenant that lenders once demanded. Net income has fallen another 20% year over year, with losses deepening as strip gaming revenue slips and hotel occupancy softens. Behind the scenes, the strain is visible everywhere. Caesars revolving credit facility is nearly maxed out, with only 12% of its $2 billion limit unused. Cash reserves have dwindled to a razor-thin buffer, and a recent waiver from lenders has come at the cost of higher interest rates and a looming material adverse change clause. Short interest in the stock has doubled, and credit default swaps have surged to 415 basis points, signaling that the market is bracing for a possible default. S&P and Moody's have both placed Caesars on negative watch, with analysts now rating the company's leverage risk as very high. In February 2026, a pre-bankruptcy restructuring memo landed on the desk of regulators and creditors, outlining a plan to cut $3 billion from the debt load and convert another $2 billion of notes into equity. But even with a $500 million cash injection from private equity, the projected outcome leaves Caesars carrying $19 billion in debt, still a towering burden over a fragile balance sheet. The Strip's biggest operator is no stranger to crisis, but the patterns are hard to ignore. Interest costs outpacing cash generation, credit lines stretched to the limit, and a market that no longer believes in the illusion of endless growth. As the numbers tighten and the waivers expire, the question is no longer whether Caesars will face another restructuring, but when. In a city that sells certainty while running on risk, the final hand may already be dealt. The story isn't over, it's unfolding in real time, and the outcome will define the next era of Las Vegas. Across all 8 collapses, one pattern cuts through the neon. Leverage always outpaces vision. Vegas sells certainty, but every casino here is built on borrowed time and borrowed money. The Strip doesn't forget, it just reruns the tape with a new name, proof that the house doesn't always win.